I think the Aisha, you're welcome. All right. I think we can get started. It's 8:05 already, and I have about six of us already in. Okay, let me start by introducing myself. My name is Abiodun Uni, but you can call me Abi. I wanted to say popularly known as, but I guess I may not be popular after all. So I like to have a feel, even though it's online, I always like to have a feel like a knowledge of the people I'm interacting with. So I'm just going to allow us introduce ourselves. I'll start. Like I mentioned, my name is Abiodun, or you can call me Abi. I work as a financial reporting analyst for an investment house or an investment firm, do asset management and the like. So generally, I can say I work in financial services industry. And just to motivate you, I would like you to know that I was also a student at one point in time, like you, with Equity Professionals, formerly known as Networth. I remember 2016, I was in class for FR, and by 2017, I qualified. I enrolled 2016 May, qualified 2017 May. So you're welcome on board. I believe you can have a better story, not a similar one, a better story than mine. You can also, wrap up in very, very short time. And I'm here to ensure that. Okay, so I want you to introduce yourself. You don't have to say too much about yourself. Just tell me, oh, my name is this. This is the industry I work, and this was my course of study. So that way I can familiarize with one or two persons at least. Even if my memory is failing me, I'll remember at least a few of my students, which I know that during the course of the class I will still come to know many of us better. So I'm going to start with my very good friend. I've known her for a bit. Alexa, you want to start? Just tell us your name, which industry you work, and what was your course of study.
Um, my name is Alexa. I'm from Philippines. For those who don't know me, I used to do physical a class before, but due to the economy changes, so I need also to align myself. So I prepare online now. Uh, and then my course of study, I graduated in accountancy, and I'm in working as a compliance officer now. I've been in this country for like 12 years with the same company. And I also do Mandarin class during my lunchtime. And during the free time, I also have I started my second degree in bachelor's in industrial engineering. So now I also finished my postgraduate here about this HRM. So just little, so my time pass is to do this kind of
Wow.
study. That's why.
Wow.
Thank you.
Well done, Alexa. Thank you. Thank you very much. Olasopre, please introduce yourself.
Good evening.
Good evening.
So my name is Tele Ayo, but you can call me Tele for short.
Okay. Okay.
Um, I graduated from Pan Atlantic University. I studied business administration. Um, yeah, and I currently work at PricewaterhouseCoopers as an internal auditor. So yeah, that's just a brief description about myself.
Thank you very much. Thank you very much. Aurelua.
Good evening. My name is Jimoh Olua. I studied accounting. I work as a cost control officer in Universal Homes. That's all about me.
Thank you. Thank you. Olatundun.
Okay, good evening, everyone.
Good
My name is
evening.
Olatudun. I studied accounting. I work with a real estate company.
Okay. Real estate. All right. Grace Uchena. Grace. Okay. Maybe she's not by her device at the moment. Aisha Yola.
Hello. My name is Aisha.
Okay.
I read marketing. I was in the banking industry for 18 years. I switched over to a civil service. I work with the government now. Thank you.
All right. You're welcome. You're welcome, Aisha. MM.
Thank you.
Good evening. My name is Ogenewari. I studied accounting and I'm currently working as a procurement coordinator in a real estate and construction firm.
Real estate as well. You're welcome, MM. Joseph. Okay. Maybe Joseph is also not by his device. All right. That was necessary to just kind of break the ice and set the mood. All right. Once again, in case you were not in when I introduced myself, my name is Abiodun, and I'm going to be dealing with just a few topics from the old syllabus. So what I intend to do today is to immediately introduce us to what we'll be doing. I'll be handling majorly the group, but not just the group part. There are also a few standards that I'm also going to be dealing with. So before the next class, I'm going to share with you I don't know if you have met Mr. Vasu. There's Mr. Vasu and there's myself, Abby. The both of us will be taking the class. So there's an allocation of the entire syllabus. I'll be dealing with majorly, like I made mention of, group accounts. And then I'm also going to be touching IAS 12, income tax. I'll be dealing with IAS 33, earnings per share, that's EPS. I'll be dealing with IAS 37, that will be provisions, contingent assets and liabilities. I'll be dealing with IAS 10 as well, which will be events after the reporting date. I think these are the 4 standards outside of group structure that I'm going to be dealing with. However, not to bother yourself too much, I'm going to share the course allocation to you so that you know for which topic, which lecturer you're going to be dealing with for each of those topics. Now, for group structure, it's quite large to an extent, so we need about 6 to 7 classes for us to fully deal with group structure, and that informs why I may have to get started with it from this class, because for FR, I understand that questions these days tend to, in recent diets rather, tend to swing across standards. So if you prepare for group seriously, you may find out that in the exam, maybe you have only 1 group question. But it can also go the other way around. They can decide to change. So what I would do is to ensure that we deal with it very well, even though it's going to be just a month and a half period. We're going to try as much as we can to drill and understand the principles and concepts as much as we can. And then my style is usually to give assignments. I like to give assignments because that's the only way I get a kind of assured feedback. The feedback is more assured than asking questions in the class. So be ready to solve questions. And in solving questions as assignments, what that does to you is that it helps you to build confidence. I quickly want to ask, is there anyone in this class that you have attempted FR before? This diet, maybe you have in the previous diet, you attempted it before. Is there anyone?
I've attempted it before.
Okay, Olatunde has done that before. All right.
And me too.
Okay.
I
Okay.
have attempted
Is there any
also.
other person? Okay,
Yes.
Aisha, you have. All right. Okay. For those of us who have attempted before, you'd agree with me that group structure happens to be one of the most interesting parts of the syllabus. Do you agree with me? Or may I even ask, how would you rate your knowledge or your familiarity with the topic on a scale of 1 to 10? Olatunde, Aisha, Joseph, how would you rate your understanding of the topic, or how interesting you find it on a scale of 1 to 10?
Okay. I wouldn't be able to rate myself because actually all the exams I took, I was running other classes. So I wasn't really prepared, but since I've registered, I just have to really do it. So for this, I hope I'll be able to focus. So I can't really say much on that.
Okay. About your rating.
I can't rate myself because actually I've been really so busy that I didn't even have time to review. I just go in and just see what I can do and do on my own. So I
Okay.
can't maybe for now that I'm really less busy, I can focus, understand, and then maybe I'll be next time.
Okay.
I
You
hope
didn't
I'll not.
take any class at all. Yeah.
No, I
All
did.
right.
I did this. I do. But the thing is that I just go in, listen to the lectures, then I'm busy. I don't have time to really go back and do like assignments because I'm really
Do assignments, and I understand.
So to understand it on my own.
Was it with equity? Was it with equity?
I did with equity, but actually I joined November. I think I joined October, I think.
Okay.
So to start going on the online classes and everything, I just did what I could do and just go. From my May, I did the classes because I'm in Kaduna. I did classes. I was going for the classes actually, but I had an intensive training in the office that took me for months. So I didn't really have time. I just went back and I had to focus on the office. So I can't really give.
Joseph, thank you very much, Aisha.
For me, I think I have attempted the exam. I hope to consolidate my knowledge. Yes.
Okay. All right. No, not to waste time. Let's get to work. So you must have heard group structures. You must have heard at one point in time, one company acquired another company, or one company is a member of Kiniko. Do you understand? You may hear, oh, this company is a member of, for instance, the EcoBank Group. To tell you that there is an affiliation between that company and the EcoBank Group. Now, what does this really translate to when it comes to financial reporting? Okay, now financial reporting is focused on the whole paper itself, is focused on very simple agenda. The agenda is we want to teach you how to prepare and how to present financial statements. How to prepare and how to present financial statements. Now, what accounting standards are the guidelines that you have for the preparation and presentation of financial statements. All the guidance that you need, all the principles that you need, all the rules that you need for you to adopt as an accountant or as a financial reporting officer or analyst, for you to prepare financial reports. Everything you needed is what is codified inside the standards. And I'm sure if you have had an introduction class, Mr. Asu would have told you the purpose of this. So you don't want a case where an accountant with company A is reporting the same transaction differently from how an accountant in company B is reporting the same transaction, the same amount, the same nature of transaction, but they are reporting it differently. Because that will give room for different practices, all right? Now, so the focus in this class is when we have companies that have a sort of relationship where one company has an investment in another company that translates to maybe what you call associate investment, or this company is a parent to this other company. What does that even mean? We're going to look at that. Now, what is the guidance of these standards regarding reporting for such entities? When you want to present the information, the financial information of the group in your annual report, how do we go about it? Okay, that is what we want to look at. Okay, so now some of the reasons why you have companies investing in another company, of course, to gain competitive advantage, to increase their profitability, to gain access into other markets. Oh, we have invested in banking business, and we have covered the full spectrum of banking, for instance. We may as well decide that, okay, let's look at other industries. We may look at other industries that are related to banking, but not the type of banking business that we have been doing all along. We can go into fintech. We may want to go into capital market operation, maybe, introduce an investment bank or introduce an asset management firm or something like that. Or we may even go outside of the industry, totally outside of the financial services industry, and go into hotel business or go into something that is totally not banking, like insurance. Do you understand? So what we're doing is we're gaining access into other markets, and that is going to also help to increase our asset base. Okay, so examples we're giving here of some of intercorporate investments that you have. Microsoft acquisition of LinkedIn, Yammer, Mojang, Skype, Nokia, and so on. At some point, Microsoft acquired Nokia. Facebook also acquired WhatsApp, Instagram, Oculus, Pass. At every point in time, we can bring it home. You have Access Bank, acquisition of Diamond Bank not too long ago. And what that means is that those companies are part of a group of companies because of their affiliation. Okay, now we will not deal too much with plenty grammar. What does this mean for us as students of financial reporting dealing with group structure? First of all, let's expose ourselves to, like I said, standards are for guidance. So what standards guide group structures? We have, I think, about 7 of them here. And I will mention the ones that we are going to be using are the one that is peculiar to us and those ones that are not very peculiar to us. Come in, let me try and pick pen. Okay. All right, now we're going to be looking at these standards. You may not be asked, okay, particular questions along the standards, but everything we're going to do is actually guided by these standards. Now, the only one I did not really put anything on, this joint arrangement. You will not learn it in this class. You're going to be learning it in CR class. IFRS 3 business combination, IFRS 10 is what sets out what we really want to do, consolidated financial statement. In this class, we're going to learn what is consolidation really. And there are two major elements of financial statements that we're going to be focusing on, which is going to be financial positions and operating, statements of profit or loss. So we'll be dealing with consolidated financial position and consolidated profit or loss. You will learn consolidated cash flows or group cash flows also in corporate reporting, which is at the professional level. Okay. Fair value measurement. Okay. We'll see a bit of that. We are not looking at it holistically as a standard. I think this also will come under the purview of what Mr. Wasiu will deal with you. So I want you to pay strong attention to the very first two, especially the very first two. This is what is really going to guide us in what we're going to be doing. Okay. Now, I have mentioned that group exists because a particular company, let's say company A is investing in company B. And when we say company A is investing in company B, we're simply trying to say that company A has bought equities or what you call shares in company B. Now, what does this investment translate to in terms of the status of A to B or the status of B to A is what I'm going to quickly touch on now. I'm going to make a very simple assumption. And what is the assumption here? I'll make an assumption that we may have an investment that is less than 20%. We may have an investment that is greater than 20%, but less than 50%. Come in. I want to use a better pen here. Okay. So like I was saying, less than 20% investment. A has made investment in B for less than 20%. Company A has made an investment in B, another scenario, greater than 20%, but less than 50%. It has made an investment of 50%, exactly equal to 50%. And another simple assumption here, where company A has made an investment in company B, bought equities or ordinary shares in company B to the tune of greater than 50%. Now, what status what status is company A going to have in company B in the first instance? In the first instance, where company A has bought less than 20% or is holding less than 20% of the ordinary shares of company B, we will assume that the purpose of this investment is simply for what they call accretion of wealth. Now, it means that company A does not have a special status. It will not have a, like I said, we are making a simple assumption here that if it has less than 20% of the shares or in equity investment in B, it is simply for accretion of wealth, and this will be dealt with as what they call financial instrument under a standard called IFRS 9. This is also outside the purview of what I'm going to be dealing with you. So what I'm really doing with you is the simplest of anything that you can have to do with in FR. But let's move on to the next stage, where company A has investments, equity investment in B that is greater than 20%, but less than 50%. Or let me even say equal to or greater than 20%, but less than 50%. In this instance, company A will be referred to as an associate. Why? Because we will assume that company A has what they call significant influence in company B. So it will be referred to as what? An associate. Now, as an associate, it will have certain rights or power that an investor that has less than 20% of equity holdings in B would ordinarily not have. What it will have is what we call significant influence. Now that significant influence may translate to one, it might mean that on the board of directors of company B, company A will have representation. Representation meaning that when board meetings are going to be held, you will have a representative of company A at that level of the board meeting. Why? Because of their significant influence. You might also have it such that when certain critical decisions are to be made, because of the significant influence of this investor, the input of company A will be considered or may be considered. They can offer expertise, their expertise in critical decision making. It will give company A access to company B's decision making, not necessarily control, but what? Significant influence. Now, this is joint venture or joint operation, which is going to be dealt with. Okay, this one is IAS 28, investment in associates and joint venture. Now, 50 is going to be dealt with, 50% will be dealt with under joint arrangement. Now, joint arrangement is IFRS 11. Remember, I mentioned that it is outside of the scope of what we want to do for FR. When you get to CR, it will be treated. Now, when the investment is greater than 50%, that is when the status of A will now be parent company. Company A will now be referred to as a parent to what? To company B. Company B in this instance will be referred to as a subsidiary. So you now have a parent-subsidiary relationship between company A and company B. Now, in this regard, this is when it will now become what we call control, or what you call controlling influence. Here we said significant influence, less than 50%. But here we are saying what? Control, or what you can call controlling influence. Now, we're going to deep dive into what that controlling influence is. But I just want to ask at this junction, do we have any questions whatsoever? Is there any question from what I have explained thus far? The summary of it, an equity investment in B less than 20% is just an accretion of wealth dealt with under IFRS 9. When the investment is greater or equal to 20%, but less than 50%, we say company A is an associate. So, or an investment in associate. So this will translate to significant influence. Now, we will not do consolidation at this point in time. No consolidation. Equals to 50%. We'll be looking at it from the angle of joint arrangement, IFRS 11. Greater than 50%, we have a parent-subsidiary relationship. And what that translates to is that company A has controlling influence in company B. So can I move forward? Are you with me? Can I move forward?
Yes, sir, you can progress.
Yes.
Okay, good. All right. So let's look at what does this power actually translate to. I mean, this control. What is the meaning of control? What does it translate to? What is significant influence? What does it mean? What does it translate to? See, don't be in haste. Just try as much as you can to understand this foundation. Let's try and understand this foundation. We'll go into calculations very soon. I know when it comes to calculation subjects, students are always hasty to go into the calculations. But don't worry, just sit back, relax yourself. Okay, let's go to what control is. I say this will arise when an investment, let me annotate. So let's just move on. I said this will arise when an investor acquires equity interest in another entity, which then results in an investor having control over the other entity. Now look at what the control here means. Look at number one. They said exposure to or rights to variable returns from its involvement with the investee. Now, exposure to or rights to variable returns. Now, what the variable returns they are referring to here means is simply the gains or losses, the profit or losses of that investee. So who is an investee? The investee is the acquired company, whilst the acquired company is the investee. whilst the person who, the company who made the purchase is the investor. So when they say variable returns here, we're referring to profits or losses. So you have an exposure to those losses, or you have rights to those profits in the form of dividend. You have power over the investee. Power will translate to policies, decision-making of that investee, and the ability to use that power to affect the amount of investors' returns. So how I will know that if I want to do a control test, these are the things I'm going to look out for, because we're still going to get to, we have made a very simple assumption that the assumption we made earlier is that to have control, then the investor must have greater than 50% equity interest. However, it is not in all cases. There's still something called de facto control, whereby we may have a case where an investor has less than 50%, but is also having control. So how do we test that instance? In such instance, you are going to have this test to, does this company have exposure and rights to the variable returns from its involvement with the investee? Does it have power over the investee? Is he able to use that power to determine the amount of returns of the investee? In such an instance, then we say there is control, even though the investment might not have been greater than 50%. And now that may happen in some instances. However, your questions will most likely, your calculation questions will take the line of the simple assumption. Company A owns 75% interest, equity interest in company B. Very simple and very direct. I know for them to have 75%, definitely it's a parent company. You're not most likely going to have a calculation question where a parent has less than 50%. However, you may be asked questions along this line when they want to test your theoretical understanding of group structure. Okay. So move forward. So what is power over the investee? What is power over the investee? Power over the investee, as you have seen outlined here. As you have seen outlined here, means that they have direct majority of the voting rights, or what is called potential voting rights. Potential voting rights here means that perhaps maybe they have a convertible instrument that if they convert, let's say for instance, they have a bond that can be converted to equity. And if they do that, they will immediately have majority of the voting rights. So that's why they call it potential voting right. That is when the investor's ownership is greater than 50%. Yeah, this speaks to power. However, you could also have a case whereby indirectly from other rights, other than voting rights, there could be also other rights. For instance, it could be that the other company A, has a right to appoint, resign, or remove key management personnel. That's already speaking to power over the investee. So that tells you whether company A has over 50% or not. They may be referred to as having what we call de facto control in this instance. If they have a right to appoint or remove another entity that directs the relevant activities of the investee. Okay, let's say company A is here and then we have company B, and then there's a company C. Company C is a parent to company. Company B is a parent to company C. However, influence, a controlling influence over company B, then that immediately suggests to us that company A has a de facto control over company C. Why? Simply because it has the right to appoint or remove another entity that directs the relevant activities of the investee. Okay. We may also have a case whereby company A is able to direct the investee to enter into or veto changes to transaction for the benefit of the investor. Or you have a case whereby it has rights, such as those specified in the management contract. Now, IFRS 10 suggests that the ability to control, the ability rather than the contractual right to achieve the above right is what indicates that an investor has control over an investee. So it defines power as existing right that give current ability to direct the relevant activities of the investee. So I will not waste too much time around it. It's very simple, it's very straightforward. All that grammar is to say that another investor has the ability to control significant or major activities or relevant activities of another company. Then it suggests to us that that company has power and that company has control over that investee. And as such, it will be referred to as a parent company. Okay. Also, I have mentioned earlier that investment in associates means that there is significant influence. Now, what does this significant influence translate to? Is what you have here: representation on the board. You have representation on the board of directors, participation in policy-making process, like I said, material transactions between the investor and investee, interchange of managerial personnel, provision of essential technical information. If you were asked in your exam, for instance, that okay, what are some of the rights or privileges that may be accorded to investments in associates? What does significant influence translate to? These are some of the points that you should mention. Now, in mentioning this, you may not have just think about what are the things that a company that does not have control but has a significant equity holding in another company. What are the possible things that, okay, they can have access to do that the other ordinary shareholders will not be able to? And then you can imagine representation on board of directors, policy-making process, participation there. When there is a material transaction, you might have major transactions that will take place between that company and the investee. Technical information, exchange of experts, expertise on certain line of business becoming. So those are the things that that they don't have control, but they have significant influence. Those are the things that it will translate to. Okay, now we're getting closer to where the real deal is. Accounting for investment in subsidiary. Now let's go into what we call consolidation. So how you account for a parent or holding company relationship with a subsidiary is different from how you are going to account for an investment in associates. Okay, let me just quickly bring that up. When we want to account for investment in associates, we'll use what is called equity method. We're still going to see this later on. But when with is parent-subsidiary relationship, we're going to use consolidation. Consolidation. And in consolidating, we mean we're going to present the financials as though whether or not this parent owns this subsidiary fully. Fully meaning that whether they own 100% of the subsidiary or not, you will need to present a consolidated financial statement that brings the account of the subsidiary together with that of the parent and present it as though it is only one entity. So that is what we refer to as consolidation. So that is how a group will present the account. That process of bringing it together is called consolidation. Consolidate the books of the parent and that of the subsidiary. Okay? Now, you may want to go over this on your own. There are a lot of foundational knowledge before we jump into calculations that are presented here. Here we're talking about instance where a parent company may not consolidate the financials of the subsidiary. Now, you will see that there is a strict rule here. Look at the condition. The condition says, if you look at the last paragraph, it says a parent need not present consolidated financial statement if and only if all of the following holds. So it's a combination of 4 things, and those things, all of them must happen at the same time. Okay? A case whereby the parent is itself a wholly owned subsidiary, or it is partially owned subsidiary of another entity, and its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated financial statements. Let me quickly explain that. What that translates to is this, or what it means is this, that A is parents to B. This is subsidiary. However, there is a P here that owns A 100%. So therefore, A may say, if I want to consolidate these books, there is still a P that is still going to consolidate their investment in us and our investment in this subsidiary. That is one point. Or P owns only 80% of A, and this parent is not objecting to A when A said, I am not going to be consolidating the financials of B. P allows it. That can be a case. Let me repeat that. P owns 100% in A. However, A is a parent to subsidiary B and company B. And A is making the argument, company A here is making the argument that if I consolidate B, P as well is going to consolidate all my financials. So therefore, there may be no need for me to have to consolidate the information of B. Or P only owns part of A. However, it has been agreed at the level of P and the minority interest holders here that, okay, don't worry, you can go ahead and not consolidate. But that is just only one of the points. The other point is that it has to be that company that is saying I don't want to consolidate is not a company that is publicly traded. That means a private company. And why is this guidance? You know, for a company that is publicly traded, you have to present your you have to publish your financial statement. So if you are publishing a separate financial statement covered under IAS 27, if you are publishing a financial statement and you are not including your investment in a subsidiary, it's kind of give off the fact that you are not disclosing a significant transaction that you carried out maybe in that year or in the previous year. You cannot have a parent holding in another company and you are a publicly traded company and you're not presenting it in your financials. That's not good enough for the market. Okay. Also, it will not be that you are in the process of issuing securities. Securities here means you are issuing maybe like an IPO, for instance, initial public offer, and you have holding in another company and you're not going to now present a consolidated financials. That should not be the case. It can't even be the case. Okay, it may also be allowed if the ultimate or intermediate parent present consolidated financial statement that comply with IFRS. Now, all of these 4 conditions must be met, meaning that there is a strict, very, very strict, very strict condition that as a parent, you ought to present a consolidated financial statement. And we are going to look at what that means now. So let's just go into that. I'm going to jump the rest of the notes and I'll go into an example for us, what it means to consolidate. Okay. You can go ahead and look at, the other bits of the note where the case where there is different reporting dates, the case whereby even if, you are a company, a parent has now met this condition and they have now exercised the right or elected the right to present their financials separate under IAS 27. There are still some conditions that are necessary to be met. Okay, now let's go to consolidated statement of financial position. Now we are going to get started now on this. Now, pay attention to this. We're going to focus on 2 consolidations. Consolidated financial position and consolidated statement of profit or loss and other comprehensive incomes. Okay, so what is consolidation really? Consolidation is very, very simple. It's very straightforward. All we want to do in consolidation, to make it very simple and easy and straightforward for you, what we are doing is we are aggregating or we are adding line by line items of the 2 companies. So let's say, for instance, in the book of company P, which is the parent, and the book of company S, which is the subsidiary, you have a line item such as PPE, 80 year, 25 year. Let's say we have an asset such as 30 year, 50 year. In their consolidated financial position, what I will see here, or as PPE, will be 105, which is the addition of 80 plus 25. Under cash, what I will see is also going to be the addition of 30 and 50, which makes 80. So that is the first thing that I want you to know. So I'm going to start with teaching you how you're going to do the adding, which is a very simple primary one mathematics, and then how you're going to watch out for what is called, or what I will call, the principle of cancellation. Now, what does cancellation mean? If there is ever a transaction between P and S, P being the parent company, S being the subsidiary. Let's say, for instance, there was such a transaction, an intercompany transaction, where P has a receivable of, let's say, 20 naira from subsidiary S. In the book of subsidiary S, we are going to see that 20 naira let's say, sorry, the person who was the receivable is parent, 20. Payable under subsidiary is 20. When we are going to be doing our consolidated financial position, we will not pay attention to this. We are going to cancel them out. Why? Because it is a transaction that took place between the two companies that are a member of the same group. And this consolidated statement here is for the group. So we will assume, we will say to ourselves, it is not possible for the same company to trade with itself. So therefore, it will not come under our consolidated financial position. This is the simplest and the most basic principle that we must first of all learn. Now, as simple and as basic as it is, when we graduate into the advanced or more technical questions, it is a principle that you will continue to observe. It is a principle that you continue to observe. Okay, so let's move to the first example that we have here. But before I move forward, do we have any questions? Do we have any, are we moving with the class? Are we getting what I'm doing? I like to get feedback before I move forward. Okay, Muibat joined later. Muibat, are you getting what we are doing?
Yes, I am, please. Thank you.
All right. Okay. All right. If you have any questions, you can either unmute or use the chat box. Okay. Now, we have presented a very simple problem here that said PICO acquired 100% of the equity of ESCO since incorporation of ESCO on 31st December 2017. Okay. The statement of financial position of the two companies on 31st December 2017 are given below. Statement of financial position as at 31st December 2017 are giving the assets, equity, and liabilities of the company. And now we are required to prepare the consolidated statement of financial position of PICO at 31st December 2017. Now I want you to pay attention to certain things. Number one thing I want you to pay attention to is the group structure. What is the group structure? You may need to first of all define that. Now, the group structure is such that PICO, first of all, is the one that acquired ESCO. PICO acquired ESCO. Now, what percentage or what is the holding of PICO in ESCO? According to the question, they said it is 100%. You need to, first of all, deal with this. Why? Because you need to be able to determine, can we say that PICO is a parent to ESCO? In this instance, yes. Why? Because our holding is over 50%. As a matter of fact, PICO owns ESCO wholly. Okay? Now, the next thing to pay attention to is the acquisition date. Which day did ESCO acquire, did PICO, I beg your pardon, acquire ESCO? Okay? PICO acquired ESCO, according to the question, from its inception, since incorporation. Since incorporation, meaning that there have never been a time that ESCO existed that it was never owned by PICO. PICO has always owned ESCO. Okay? Now, the last one, or the third thing I want you to pay attention to, we'll move on to the other layers as we move up, is the consolidation dates. And what is the meaning of that? Which date am I expected to present a consolidated financial statement? According to the question, you will see that the statement of financial position we were given already tells us that it is drawn up as at 31st December 2017.
Okay.
And that is the requirement. So that means the consolidation date is 31st December 2017. As we move up, you're going to understand why these building blocks are so important. Okay, now let's look at our solution. You will see that our solution, what was done here, was simply additions. Okay, but before we go to the additions, you might notice something here. Look at the line where you have investment in ESCO, 60,000, right? Isn't it? And look at the line where you have ordinary shares. Ordinary shares, ESCO, 40,000. Okay? Now, when you come here, under non-current assets, in the solution, okay, 1 minute, please. A moment, let me quickly erase the things that I had written earlier. You will notice that in the consolidated statement of financial position, you no longer see investment in ESCO. Why? This transaction here is a transaction that took place between PICO and ESCO. PICO paid a consideration of 60,000 naira to acquire the net assets or equity of ESCO. If you look at equity of ESCO, ordinary share 40,000, share premium 20,000. That makes up how much? 60,000. Now, investment in ESCO is not showing on my consolidated statement of financial position. Look at assets, it's not there. Now, when you come to equity, you will also see that it is only the ordinary share capital of PICO that is showing. Look at it. Ordinary share capital, PICO 100,000. I'm sure you will see the share premium and you will see that there as well, 125,000. Now, why is it that we are not seeing this 40,000 and 20,000? This 60,000 investment that PICO made in ESCO is an intercompany transaction. So therefore, this will cancel this.
Yes.
However, apart from this, we are free to go on and do what? And add the other things. You can see it's very simple. PP 320 in parent, 62,500 in subsidiary. What do? You add them together. Current assets, 70,000 in parent, 10,000 in subsidiary. What do? Add them together. If there are any other assets, in as much as they are not, and it is not a transaction within the group, what do? You add them together. Okay? So it is the cancellation principle, this cancellation principle, that you have to cancel out any transaction that takes place between the parent and the subsidiary that is going to give birth to other things that we are going to see in the course of the class. You can see every other thing was added. When we got to equity, we could not add the equity of subsidiary. We could not add the share premium of the subsidiary. Understood? Now, we would be able to add the retained earnings if they add retained earnings after any retained earning after acquisition. We're going to come to that and you're going to understand that better later. Do we all get this? I want your yeses and your no's if there are any no's. Is there anyone who does not understand this? Can I move forward? You can see they mentioned this. The first thing you need to note in investment in ESCO cancels out the equity that was paid for in ESCO. So let's move on. The group structure, the acquisition date, the consolidation date. Like I made mention, you must not forget those things. Very, very important. Very, very important that you don't miss out on those information. Now let's look at another problem, yeah? Now, they said PICO regularly sells goods to its subsidiary company, ESCO, which it has owned since ESCO's incorporation. The statement of financial position of the two companies on 31st December 2017 are set out below. So I want somebody in this class to tell me what transactions are we going to cancel out? What transactions are we going to cancel out when we are going to draw up our consolidation? Can everyone hear me?
Yeah.
Yes. Yes, we can.
Okay. Oh, yeah, now let's do this. Let's do this. I want you to look at the financial position of the two companies. We are going to consolidate them now. And we all know what consolidation means. We're going to add up line by line items of the parent and the subsidiary. However, the cancellation principle means that any transaction that takes place between these two companies, we will need to cancel them out. Okay? Anybody wants to try? Before I go on.
We'll cancel receivables of 100,
Cancel our
of 1,000.
receivables okay, of 1,000. Okay, who owns the receivable? It's the parent company, right?
It's the parent, yes.
Okay, so if the parent has a receivable of 1,000 naira in their book, and they say that receivable, the person owing us or the company that owes us is ESCO. When I look at the payables under liabilities of ESCO, I should also see that ESCO is saying we owe PICO 1,000 naira. Is that the case? I think, yeah, that's the case. In case you don't understand what I'm saying, look at it. Let me annotate for you. Look at this. In the books of ESCO, ESCO is recording that we owe PICO 1,000, okay? Also, in the book of, what is it called? Of PICO, they're also saying we have a receivable of 1,000. Now, this is going to cancel out the other 1,000 that you have in the payables okay, now, we add an earlier one, investment. This investment as well, this 20,000 naira is going to cancel out the equity, the net assets that we acquired, equity of ESCO that was acquired, okay? If you come to the equity part, you see that 20,000 naira here. This is to be cancelled out, okay? Now, let's go to the consolidated financial position. See the solution. See, PPE was added together. When we came to current assets, we did the others. We did not touch that 1,000 naira. We had cancelled them out. See, when it came to retained earnings, we added the retained earnings. Somebody will say, okay, why didn't you take out these retained earnings here? Why did you add this 9.5? It's very simple. If PICO owned ESCO since its incorporation, it means that all the profits, and especially because PICO owns 100% of ESCO as well. Two things I want you to note there. PICO owns 100% of ESCO, number one. Number two, PICO has owned ESCO since its incorporation, meaning from the very first day. So all the retained earnings that ESCO has in a book, PICO has a right to all those retained earnings, all those profits, 100%. So I can easily come here and do what? And consolidate their retained earnings. Add the 8,000 was the 9.5. Now this is very instructive. When we get to the more advanced questions, you're going to see, does anybody have a problem with this so far? Is there anything confusing you? I seem to be thinking maybe, am I not too fast? Do we get it?
Is there any other account title that aside from the investment and the receivables?
Yes, there are other instances where you can have intercompany transactions. They are more complex ones than this. But for now, I just want us to learn the cancellation principle because it holds every other thing we're going to do. Babajide Ajayi is raising his hand. You can please unmute and speak.
Okay, thank you so much, sir. So I have two questions. So the first question is that, okay, now since we are canceling, we are removing some things out of the consolidated the consolidated statement. So what is the impact of that on the overall financial performance? Does it mean that the final statement of financial position will not actually give a true picture of the position of those combined entities? That is one. Then another thing is that, okay, the other time you said that said something around retained earnings, that that if, for instance, is a parent company owns owned the subsidiary from inception, it means that that the parent company has access or right to all the retained earnings of the parent company. So what about if the parent company acquires the subsidiary at a point not from its inception? Thank you. So what will the case be? Thank you.
All right. Very good question, Ajay. Let me start with the last one. The last question, we were speaking about retained earnings, and I mentioned they have a right to the retained earnings of ESCO. Now, mind you, I said two things. I said, number one, PICO owns 100% ESCO. Abi, 100% equity interest in ESCO. So that is what gives them, first of all, right to take 100% of the profit of ESCO. Number one. Number two is that we also made mention of the fact that PICO has owned ESCO from inception. So therefore, it has right to all the retained earnings. So your question is, what if ESCO had existed before PICO now acquired ESCO? In such an instance, it will be impossible for PICO to have a right to retained earnings. Well, you know the meaning of retained earnings? Retained earnings means they had profits that were undistributed, that they were accumulating over the years. So if I come in and I acquire your net asset, you see, from the date of inception, from the date of acquisition, that was why I was mentioning date of acquisition, we're emphasizing it. It is from the date of acquisition that PICO will now have a right to the retained earnings of ESCO, meaning that we will now need to make a distinction, a separation between the pre-acquisition retained earnings and the post-acquisition, which we are still going to get there anyway. We're going to get there. I'm just going to take it one by one. Alexa, your answer is up. Well, have I answered your question, Babajide?
Yes, but I want to ask another question, sir, as a result of your explanation. So let us now assume that PICO does not own 100% of ESCO, and then it didn't own it from.
I get where your question is going. We're going to get there. We're taking it layer by layer by layer. You see, okay, this very simple layer. I want to believe you're asking these questions because you probably have attempted this exam before, or you have been exposed to the knowledge. Don't worry. We're going to get there. I'm building layer, I'm building blocks here. In such an instance, we're going to have what we call non-controlling interest. That is, there are other parties that do not have control over the entity, and they are going to own the remainder of the equity. So they are going to have a right to, the fact that they don't control the company does not mean they don't have a right to share in the retained earnings. They're going to have their share. We'll get there. But just understand that for now, I want everybody to understand that consolidation, whether the company owns it fully or not, you are going to consolidate in as much as it is a parent-subsidiary relationship. And in consolidation, you will do it as though the parent company owns all of the subsidiary. However, there will be that distinction when you get to retained earnings. Okay, I'm going to come back. We're going to go back and we'll go further. But before then, Alexa, you may go ahead, please.
From the title itself, we called it a simple consolidation. So what is a simple consolidation meaning? And when are we going to use this as a presentation of the FS? How can we, which question is answering this type of uh, presentation? And second, since he owns this ESCO, then he also liable in any obligation the ESCO have.
Yes. Yes. Okay. Simple consolidation is what, in fact, the consolidation we will do throughout the entirety of this class will be referred to as simple consolidation. The reason is that what we are going to focus on in financial reporting, FR, this paper, is going to be a direct parent subsidiary relationship where PICO bought equity interest in ESCO as direct as that. But while I was making some explanations, you would have seen instances where I mentioned a parent company owns a subsidiary. That subsidiary now owns another subsidiary. You will never have to deal with such a situation in FR. You will never, they won't give you a question like that to do. That is when you now start to do complex structures. But for now, for FR, all of it is simple consolidation. And as for presentation, this is not exactly how you're going to present. All these additions that we are showing is just for tutorial so that you can understand the process that led up to final answers. Does that answer your question, Alexa?
Yes.
All of this will not be in your presentation. Should be part of it. Okay. So can I move on to the next question? Does any other person, any one of us, any other person have any other question? Can I move forward? Babajide Ajayi. Okay, go ahead.
Okay, sir. You have not answered my first question, sir.
Which one? Impact. Okay. Okay.
Yes.
In terms of impact, the answer is no. The aim of the consolidated financial statement is not, the aim is to give the picture of the financial information of this group as one entity. Do you understand? As one entity. Now, if you are presenting it as one entity, that one entity cannot trade with itself. That's the simple ideology behind it. That one entity cannot possibly trade with itself. And that is why when you're looking at it from the perspective of the group, you have consolidated the numbers of all the subsidiaries and that of the parent. But you see, in practice, what usually happens is that the parent will provide you side by side, under the same package or under the same package, you will see the position of the group, and then you will see the position of the parent itself. Do you understand? So if I'm looking for the financial position of the parent itself, I'm going to see it. If I'm looking for the financial position of the group, I am also going to see it there. So, but when I'm looking at the financial position of the group, I am looking at that parent company in consolidation with the subsidiaries. The numbers have been matched together, they have been aggregated together. However, transactions that take place between the two entities will not appear because we are presenting it as one entity. Does that make it clear?
Yes, sir. Thank you, sir.
You're welcome. Okay, let's move forward. Let's move forward. So I want to believe outside of this class, especially for those of us that are beginners, you will go back, just continue to follow this very simple process. Everything hangs on this, and you're going to appreciate it more and more the higher we go. All of your group consolidation is very simple. It's still the same principle I'm teaching you that you're still going to abide by when we get to even the complex questions. You just must not forget it. And you just must continue to do the simple things when you get even to more complex questions. Okay? Don't forget that I made mention of it. Don't forget your group structure is very important. First of all, set that out. Set out what is the acquisition date. You must ask yourself, what day did PICO acquire ESCO? What day was it? Okay, this one says this is the corporation. And now, the consolidation I am doing it as of which date? As of which date am I expected to present this consolidated financial statement? Also very important. And please take your time to look at the tutorial notes as well. Okay, now problem 3. We have investment in equity, debt, and current account. Okay, let's move on. The statement of financial position of PICO and of its subsidiary ESCO have been made up to 30th August 2017. PICO has owned all the ordinary shares and 40% of the loan stock of ESCO since incorporation. Okay. When you come down here, they say the difference on current account arises because of goods in transit. I'm going to explain that later. They said prepare the consolidated financial statement of financial position of PICO at 31st December 2017. I want to believe it should be 30th August 2017, not 31st December 2017. Okay? Even the solution is 30th. But before we even move there, I want to ask again, what transactions are we going to cancel out? What transaction are we going to cancel out? You can use the chat box and you can unmute. What transactions am I expected to cancel out here?
So I think we are in the first instance, from what I'm seeing here, we have to cancel out the investments, PICO's investments in ESCO.
Okay. Let me put numbers to it.
Like the 40,000 and the 10,000, the ordinary shares and the 12% loan stock.
Okay. Okay. But is it not a problem? Okay. Now, if I am to look out for where this 40,000 exists in the book of ESCO, I will look at equity, ordinary shares, 40,000. Abi, you cancel it out, right? Now, when I have to look out for this 10,000 naira, 12% loan stock in ESCO, I come to 12% loan stock and I'm seeing 25,000. Is that a problem?
Can you pull up?
Okay. Is this okay?
Okay. Now, well, with what I'm seeing now, there is a problem because the figures don't tally.
Okay. There's no problem. There's no problem.
Okay.
We're going to see how that will be dealt with. Okay. Now, also, that is not all. That is just the investment in ESCO. if you look at the question, I want somebody else apart from, I think, very good one, Babajide is following, but I want somebody else, maybe a lady in the class, to tell
Okay,
me.
I think
Okay.
I think
Right.
current account with ESCO 9,000.
Okay. Okay. Did you say it? Current account with PICO
6,000.
you are going to cancel out, right? You think there's a problem because one
Yes,
says
because the figures are
9,000.
not the same.
All right. Thank you. Olatunjo, right?
Yes, sir.
Thank you for your contribution. Now, you see, the principle of cancellation does not necessarily say that that transaction, when I look at the book of PICO and the book of ESCO, I am going to see the same balances there. Not necessarily. Now, let us consider the first instance where I was talking about loan note. Remember, you were even told right there in the question, they said PICO owned all the ordinary shares. So therefore, in terms of ordinary shares, if the investment is 40,000, then I should see ordinary shares of 40,000 because it owned all of it, right? 100%. However, when it came to loan stock, they told us it owned 40%, right? So when I look at the loan stock of ESCO and I'm seeing 25%, if I do a quick math, 40% of 25% will give me what? Will give me 10,000. Yes, it should give us 10,000, right? It should. So what I am going to cancel out is only 10,000 investments in loan stock in the book of PICO and 10,000 12% loan stock in the book of ESCO under liabilities. So I will only take out 10,000 that belong to PICO out of this 25,000. And I'll be left with what? 15,000. Now that 15,000 belongs to other parties. So therefore, I am going to consolidate the 15,000. Let me repeat that. Cancellation principle does not necessarily mean that I want the same balance in the book of the parent and the book of the subsidiary. The only thing I need to pay attention to is what is the worth of the transaction that took place between them. I will take that out and I will consolidate any transaction that came from third parties. So we are going to say only 40% of this 25,000 was purchased by PICO. So therefore, that will not be consolidated. The remaining 15,000 must have been gotten from other parties, third parties, that are not a member of the group. So therefore, those ones are going, that amount is going to be consolidated. Now, let's quickly look at current account with ESCO. Now, when you see current account with ESCO in the book of PICO under assets, what it means is that PICO is saying ESCO owes me 9,000. Whether goods, what 9,000 I am expecting ESCO to supply to me, or at times it can be cash. I'm expecting, I have sold to ESCO, I'm expecting cash of 9,000 naira. If you see current account with PICO like this, under liabilities for ESCO, what ESCO is saying is that I owe PICO either goods, what is that amount, or cash, what that amount. Now, they said the difference on the current account arises because of goods in transit. What it simply means is this. You see? Now, 3,000 naira, what you should have here is 9,000 9,000. And what you should also have here ordinarily should have been 9,000. But from the records of ESCO, the goods worth 3,000 are already in what? In transit. Goods worth 3,000 already in transit. So therefore, in their own books, in the books of ESCO, they will not have that 9,000. They would have taken out 9,000. They would have taken out 3,000 from that 9,000, and that's why you have 6,000. So when I am consolidating, I will need to reconcile that difference. I will need to reconcile that difference by bringing out a new line called goods in transit. Now, I'm going to consolidate these goods in transit. I will cancel out the 6,000 current account with PICO in the liabilities of ESCO. I'm going to also cancel out the 6,000 in the account of assets of PICO, current account with ESCO. I'm going to cancel out that 6,000. Then I'm going to introduce this line, goods in transit 3,000. Let's look at the solution together. So you will see we don't have an issue with every other line. We're just going to sum them up. Sum up every other line, but cancel out intercompany transaction. So therefore, in the assets of PICO, when they will be presenting their consolidated statements, we're not going to see loan stock. We're not going to see investment in subsidiary equities. We're not going to see it there. We're also not going to see the ordinary share capital of ESCO, because that will be the 40,000 that will cancel out the investment in ESCO. However, we're going to add up the retained earnings. We are going to add up every other thing, but we'll take out the 10,000 loan stock. We'll take it out here, and that's why you have 15,000. So what I want you to do is for you to attempt this, and this is how you're going to do it. Present it like this. When you're doing it, first of all, determine what is the group structure. Is going to be very important when you start getting to the more complex questions. Always ask yourself, what is the group structure? The question says PICO owned all of ESCO. It said has owned all the ordinary shares. So PICO owns 100% of ESCO. Now, acquisition date, it had acquired ESCO since incorporation. Since the inception of ESCO, PICO acquired ESCO. Now, consolidation date, the date that you are presenting the financial position is, or financial statement, is your consolidation date. So they gave you 30th August 2017. Okay, we may need to change this. I know it says 31st, but I already mentioned it. That was an error. It should have been 30th August 2017. Okay. And then we move on. But do we understand this? Because now we have introduced something. What have we introduced? We have introduced instances where we are canceling, but the amount, the balances are not the same. And I think to the extent that they are the same is to the extent that they are going to cancel. Translation does not mean I'll just cancel like this. I will cancel the amount or the balance of the transaction only to the two transactions that happen the parent and the subsidiary. Okay. So let me move on. Oh, Alexa, please go ahead.
So what if the subsidiary incurred losses? What are we going to do?
Yes, the parent is exposed to the losses of the subsidiary. So when we are combining, retained earnings we added, Abi. So if they have accumulated losses from, let's say for instance, let me use this illustration. For instance, they have in their books accumulated losses of let me annotate. They have accumulated losses of 14,000. Ordinary shares, 40,000. And this will give you 26,000. Now, what would happen is when I want to add this retained earnings, it will be 47,500 minus 14,000. And that will give me 30 what? 33, is it 33,500? So the retained earnings of the group will be 33,500. So if there are losses, loss means there's a negative. So you take out that from the retained earnings. Is that clear, Alexa?
Yes, sir.
Okay, let's move on. So now we come to problem 4. An instance where the parent does not own all of the equity interest in ESCO. Instead, the parent owns equity greater than 50%, but not 100%, less than 100%. Now, in this instance, let me quickly explain this. In this instance, remember we said if you have over 50%, it translates to you having controlling influence. I mean, not significant influence, controlling influence. Don't forget that. Now, you have over 50%, but you don't have 100%. So the remainder, the investors that own the remainder will be referred to as NCI, non-controlling interest. Now, this non-controlling interest, what it means is that they are now going to have rights to share in the profit, of the subsidiary. Profit of ESCO. They are going to have rights to share in the profit of ESCO. So not only PICO has a right to the dividends or to the profit of ESCO. Now, that said, it still will not stop PICO from presenting a consolidated financial position, even though it does not own 100% of ESCO. It will still go ahead to present a consolidated financial position. Is that understood? Is this bit understood?
Say
Yes.
again, sir.
Okay. Now, we have a very simple assumption, yeah? I know it's a simple assumption because when I'm looking at the numbers, yeah? The investment in ESCO is 15,000. I mean, investment in ESCO is 15,000. Now, when you come to the ordinary shares of ESCO, you see 20,000 ordinary share capital, isn't it?
Yes, sir.
isn't it? And if you do 15 over 20,000 times 100, you are going to get 75%. So, peradventure, I was not told. Let's say I was not told, the examiner did not tell me that the group structure, the first thing we want to figure out is the group structure. If the examiner had not mentioned 75%, PICO acquired ESCO. Now, when I'm looking at PICO's investments, the investments all over the ordinary shares will be 10,000 over 15,000, Abi, times 100. Sorry, 15,000, pardon, 15,000 all over 20,000. Times 100, and this will give me 75%. So I know ESCO bought 75. Pardon me, 75 holding in ESCO. Now, what does this mean ordinarily? It means that my NCI, therefore, will be 100% minus 75%, which gives me 25%. Meaning my NCI holding is 25%. Now, the fact that NCI owns 25% does not really tell me what measurement of NCI will be. I'm going to come back to that. My spirit says I should hold on, I should calm down. So we have figured out the group structure, number one. What else is there to figure out? The acquisition date. Abi? So let's look at it. What was the acquisition date? Acquisition date, they said since incorporation again. Since incorporation. Sorry. Since incorporation. Now, what is my consolidation date? My consolidation date is 31st December 2017. So this one is since incorporation, and acquisition, consolidation date is 31st December 2017. Okay, it means that PICO has always owned 75% in ESCO, and NCI has always been 25%. Now, how do I consolidate this? How do I consolidate? I want you to pay close attention here. So because now we have introduced NCI, which is non-controlling interest. In this instance, the parent company no longer owns 100% like we have been doing or that we have been dealing with. Look at what happened here. They own 75%, acquisition and all of that. Now, pay attention here. NCI is 25%. Yes, we know. And NCI is part of the group, even though they do not have controlling interest. However, IFRS 3 says that we can measure NCI in two ways. What are the two ways to measure NCI? We may measure NCI as a proportionate share of fair value of the subsidiary net assets, or the full of fair value. Now, what is the meaning of this? Very simple and straightforward. When I am looking at the ordinary shares of the subsidiary, there's something called its book value, and there's something called the market value. When I'm looking at this first method, which is very direct, if ESCO is 20,000 shares at 1 naira per unit per share, meaning 20,000 naira ordinary share capital. And NCI is 25% like in this case. I am going to measure NCI as 25% times 20,000 shares times this share is quoted at what? 1 naira in the books times 1 naira. And that will give me 5,000 naira. Very simple, very direct. But if my examiner, which is mostly going to be the case, wants me to measure NCI, they are going to tell me. If they want you to measure NCI at full or fair value, they are going to tell me what is the market price of these shares. Now, what is the difference between this book value and the market value? The market value is telling you the price that somebody who wants to buy the shares of that company will buy on the stock exchange market. For instance, of recent, I think GTCO issued shares. Now, when you look at the books, you can make that attempt. You look at their books, you may see their shares in the book at 1 naira per share. But when they were going to sell those shares, they were probably sold at maybe 38 naira per share. Or you look at the stock exchange market as of today, the price may have closed at maybe, let's even make an instance, a very simple instance, at 5 naira per share. Meaning that the market price is different from what you have in the books. So when I want to calculate at full or fair value, what I'm going to do is, I'm not going to make an assumption that it is a proportionate. I am going to say, how many shares does NCI own? NCI owns 25% of the 20,000 shares of the subsidiary, which translates to maybe 5,000 shares. Now, those 5,000 shares, I will multiply at the market price, which will equals how much here? 25,000. This will be the value of the shares or the worth of shares of the NCI when I want to measure the NCI. Okay, so you must understand this. For now, for the question we want to solve, you will notice that we were not given a market price. We want to make a very simple assumption here that we are going to be measuring at proportionate share of the fair value of the subsidiary's net assets. Proportionate share. Does anybody have any question along this line? I think it's clear, but it may not be clear to one or two of us. You can raise your hand. If it's not clear, you can raise your hand. Okay. In the absence of any question, now let's go back to what we were doing. You can always come back to read this. Now, my solution will go thus. I am still going to be applying the principle. I am still going to be applying the principle of cancellation. Now, what am I to cancel? Very easy. I am going to cancel the investments. The investment of PICO and the NCI against the ordinary shares of ESCO. Mind you, let me go there so that we don't lose track of the question. Why is my system not scrolling up? Sorry. I think we're on problem 5. Okay, problem 4. Okay. So what am I going to do here? Very simple. Yeah, it is true that in the former questions, all I have done was to compare this investment in ESCO versus the net assets of subsidiary. Abi? Now, in this instance, we are going to add the investments, the purchase consideration of PICO plus NCI versus the net asset of the subsidiary. Why are we doing that? Because this only accounts for 75%, right? However, there is still a part of the group, because the way we are going to structure the group account, we'll do it with the assumption or the ideology that all members of the group is presented as one entity. So therefore, that 25%, we'll need to add it to this 75% before we can cancel it against the net assets of the subsidiary. Okay? And you will notice that that was done. Is there another thing we need to cancel out here? I don't think they brought up anything for us to cancel out here, because the focus is really on NCI. The focus is really on NCI. Okay. Now you will see that I am no longer seeing investment in ESCO, but you can also pay attention to something here. Let me annotate so that you can understand what I'm referring to. You come here and you see this. 12,005 retained earnings of the parent plus only 75% of 5,000 retained earnings in ESCO. But then, after that has been done, a separate line is showing us the value of our NCI was 5,000. How did I know? Investment in ESCO was 15,000. Are we together? Ordinary share capital of ESCO was 20,000. So therefore, the remaining 25% must be accounted for as this 5,000. Since it's proportionate share, we can do 25% of 20,000 and we get 5,000 also. However, if the retained earnings of ESCO is 5,000, PICO has taken 75%. I mean, the remaining 25% . 25% will be taken by the NCI. If you do 25% of 5,000, you have 1,250. If I add this together, what am I going to get? I'll get 6,250. And that is how they got 6,250. Okay? That's how they got 6,250. And the rest was consolidated by aggregation. Okay? So how do I cancel out when there is NCI? When there is NCI, after I have dealt with group structure, and I notice that there is NCI, I move on to acquisition dates. I move on to consolidation dates. And now my consolidation date tells me something. And we are going to get to that later. I move on to what is called cancellation. I ask myself, what are the items of or transactions that took place between the subsidiary and our investors? Our investors are who? The parent company and the NCI. Now, the parent company got only 75%. So I need to add that value to whatever 25% represents. Now, mind you, I am careful here. I said whatever 25% represents. 25% may be accounted for in two ways. Proportionate share of the fair value of net assets of the subsidiary, or the full or fair value of the shares. Meaning that in that instance, we are going to be multiplying by market price. So whatever that value is, I'll need to cancel out against the investment, against the net assets of the subsidiary, the equity. When I've done that, I also need to be careful about something, understanding the fact that the retained earnings of the subsidiary is no longer only owned by the parent. We also have to share it into 75% and 20%. 75% and 25%. Now, also bear in mind that I am going to be showing my NCI on a separate line. I'm showing it out on a separate line. I'll be adding the measurement of my NCI plus the share of the retained earnings, just like we did here. What I explained, that calculation breakdown that I explained just now. That is what I'm going to be doing. Okay? Now, I like to be very practical. I will only take up one more problem for this class, which will take us into what is called goodwill. After that, we'll move to the end of the class. My expectation is this, that you see, I have a mantra I live by. In accounting, no matter how simple it is in class, you have a responsibility to go back and do it by yourself. I have explained the principle. It's quite straightforward. But you have a responsibility to take up these questions. If you are a beginner, if you have not done this paper before, or you've even done it before, you did not really get it. This is a very good opportunity. Act as if you've never learned it before, you're learning it anew, and take it with these baby steps I'm teaching you. And be doing your consolidation. Step by step. when we come to the more complex questions, I don't expect you to have a problem. Somebody wants to speak?
Yes, sir. Hello. Can you hear
Go
me?
ahead. Go ahead. Go ahead.
Thank you very much for the step-by-step teachings and all of that that you have been putting us through since 8 p.m. But I would like to suggest that if only you could just, take up the question and bring up a plain board where you just, start from beginning and be solving the question without the solution. Because I know you've already given us the solutions and it's already in our listing. But if only you could just like have the question, then open a plain board and solve, have a working note, like so that we can be I don't know if the others, I can be able to be, I'm getting it as much as I can get, and it's so interesting. But I really appreciate if that procedure could be taken.
Okay, thank you very much. Thank you very much. That is noted. That is noted. Okay. You have the. Do we know we have the material on our WhatsApp group? This material.
Yes.
Yes, sir.
Because my initial concern was if I was sharing a white plain board, it was when I was about to start this session that I sent the material. So I was not very sure everybody had it downloaded. But now that you have it downloaded, no problem. It makes it, I think it will make you see me doing it from the scratch. But is there anyone, I just want to be sure, is there anyone here that with the steps we've taken, you are still not sure that if you were to consolidate those examples that we've done on your own, that you'll be able to do it? Is there anyone?
I think
Yes.
sir.
Yes, sir.
Yeah.
Peter,
Yes, sir.
okay, when did you join the class? Did you join at the point where I had started already?
No, I joined very late. I joined very, very late. I joined like about 15 minutes ago.
Okay. Okay, no problem. We were going to send you a recording of the class. That's why we are recording the class actually.
Okay, sir.
Alexa.
Okay, sir.
Maybe because in FR a topic is very broad, so it can help us this way, new technique for me, as I observe. Uh, the way you do it is quite more. We can tackle more as long as we have the materials ahead of time, or maybe that particular day. We have our working papers already, which one and which one. Then we can just fill out which to cross out or to fill also while we are listening to you. So we can also write it by, I don't know, sir, if that
All
one
right.
for me is this one is quite a time saving for everybody, especially in the night. It's not, uh let's say this thing that everybody comes from work or this thing. But if we have maybe some working papers, I mean, like free, all of the accounts was there. I mean, we can just print it out and just we can put a figure. I don't know, sir.
I understand what you're saying as well. Like a
Template.
separate
Like
template.
yes,
Okay.
sir.
Okay. I'll look into that as well. What I will do is, thank God I'm getting your feedback, and we'll look at a way where we can find a balance and then ensure that everybody is carried along. That is my biggest
Because sorry,
worry.
sir. I observed that the pen you are using also are not the typical pen that easy to write faster.
Yes, that's another challenge.
One instructor do it like is
Light
good.
pen.
Yes, that the stylus pen something. And maybe his desktop or laptop is a touch screen, so I easily just write it easier like that. But I don't know what are you using, sir. So I think
It's a
that's
touch
also
screen, but
constraint.
the fact that I'm using my hand, yeah, kind of.
Oh, that's the thing. So I think
But
template for now will be helpful. So we can easily print ahead. And then when we join the class, we can just do the working paper and then we just cancel which one to cancel, which one to this thing, do some modification on it. And then that's our everybody is working.
I understand. Okay, I get it's going to be a mix of the two. The reason being that I quite understand Grace's recommendation. At times, students get it better when they see the lecturer do it from scratch. In an instance where the solution will not take too much of our time, we can quickly do that because we also have to do what we are doing with time as well. And for some complex questions that I do not expect to also take too much of time, if the foundation has been well laid, we can also build the solution together from scratch, and also have a template that helps you do like a walkthrough. All you need to do is just edit the numbers per question. I get your own recommendation as well, which is fine. It's also part of the reason the class will get better as we go on. It's also one of the reasons why I am not going to go too far. I'm just going to look at one more problem, which is the problem of goodwill. Sorry. Goodwill and pre-acquisition retained earnings. Okay. So now let me quickly speak about what is called pre-acquisition retained earnings. So
Excuse me, sir.
go
Sorry
ahead.
for interrupting. Please, I was just wondering, I don't know if I didn't get the clear picture. Why, when in the consolidation statement or the consolidated statement of the last example we did, I noticed that under NCI, you merged the retained earning plus, is it the ordinary shares or something, 5,000?
Yes, I
Is it the
said.
ordinary shares?
Now, that ordinary share, you won't call it ordinary share. It is your non-controlling interest. That is the measurement at acquisition. Okay, the measurement at acquisition of this NCI. Let me annotate. The measurement, we said there's 20,000 shares. Sorry. We said there's 20,000 shares in ESCO. Abi?
Yes.
So PICO acquired 15,000 shares. Right? Now, how did I know it's 15,000? The investment is 15,000 naira. The shares is what 1 naira each. Abi? So if I divide that by 1 naira each, it means they acquired 15,000 shares. Abi? And this is all the shares in PICO Abi? Now,
Yes.
NCI, parents would have owned 15 over 20,000, which is 75%, right? Meaning that
Yes.
NCI owns 25%. We said NCI can be measured proportionate share of the net assets of ESCO, Abi, or the fair
Yes.
value. Now, if you were not given the market price of the shares of ESCO, you will not have any means by which you can do the second method, which is the full or fair value. You will not be able to do the full value or fair value, meaning that
Yes.
it will be easier for you to do proportionate share. And what is the proportionate share? Proportionate share means I'm simply going to do 25% times 20,000 times the book value. Now, the book value will be in the question. 1 naira times 1 naira. So meaning that as at the day of acquisition, the measurement or the value of NCI was 5,000 naira. Okay. Now, between the day of, you must understand that retained earnings means we were accumulating the profit. We did not share. Abi, ESCO did not share
Yes.
this profit. Abi, they were accumulating it from the day of inception. Now, from the day of inception till the date of consolidation, the date of consolidation is 31st December 2017. They had 50,000 naira. 5,000 naira worth of profit. ESCO had generated 5,000 naira worth of profit. Now, PICO will take 75% of this, which will translate to, that should be, is it 3,750?
Yes.
Right? If you add 3,750 to the 12,005 here, you will get 16,250. All right?
Yeah.
Now, NCI will take the remaining 25% of this 5,000, which translates to 1,250. I am now saying, when I want to measure my NCI now, I will take the measurement from inception, 5,000, and I will now add it to the share of its profit of 1,250. And that's how you will make up 6,000.
Okay. So if I understand you clearly, where we have NCI, the ordinary shares that we see in consolidated is only representing the shares of the parent company. NCI also now carries NCI and maybe if there's retained earning or whatever it is. Let's assume there's no retained earning, we only have 5,000 there.
Absolutely.
Okay. Thank you. Thank you, sir.
Okay, let's look at pre-acquisition. Now, pre-acquisition, pre means before. So pre-acquisition is before acquisition. You have a case whereby a subsidiary had existed prior to its acquisition by another company. In such an instance, I have mentioned before, I'm going to mention again. Look at the situation we just solved now. We have a parent, we have an NCI, okay? Now, in this instance, they are to share the retained earnings of the subsidiary. And it is quite easy because that subsidiary had been acquired by the parent from inception. So it's straightforward. However, how about we have a situation where the parent has not always controlled the subsidiary. They did not acquire the subsidiary until a point in time. Remember what I said earlier. the parent will only take a share in the retained earnings of the subsidiary from the day it acquired it, meaning that the pre-acquisition retained earnings, the parent will not have a right to share in those retained earnings. Okay, now let's look at the question. Okay. Before I leave goodwill, there's something we call goodwill on consolidation. So far, if you still pay attention or if you still remember what we did the last time, when I was going to do my cancellation, I did not do my cancellation only on the investment of the parent, which only accounted for 75%. So I did that cancellation by adding the investment of the parent and the non-controlling interest to cancel out the net assets of the subsidiary. Now, I am going to do the same thing now, but we are going to see a situation here where it is possible that what the parent company has paid, the earlier versions or earlier questions, the investment in subsidiary and the equity that was acquired, they were the same numbers, right? You could have a situation where what the parent has paid is higher, a higher value than the book value or the fair value rather of the net assets of the subsidiary. In such a situation, that difference will be referred to as goodwill on consolidation. Now let's look at it together so that you can understand what I'm saying. Let's look at it together so that you can understand. So now, PICO acquired the ordinary shares of ESCO on 30th June 2017, when the statement of financial position of each company was as follows. Okay, we're giving the assets. If you pay attention very well, investment in 25,000 ordinary shares of ESCO, and the amount was 40,000. Okay, when you look at equity and liabilities, the ordinary shares of ESCO at ₦1 each was how much? 25,000 naira. Okay, meaning that first thing first, we are looking at a situation where, I'm sorry, let me see the rest of the question. We're told to prepare the consolidated statement of financial position of PICO at 30th June. Okay, let's follow the same process. First of all, what is the group structure? Now, in this question, nothing here suggests to me that there is an NCI. Okay, why? There are 25,000 ordinary shares. ESCO has 25,000 ordinary shares. PICO has made an investment in those 25,000 ordinary shares. So even if they did not tell me that PICO owns ESCO wholly, I can tell that it is 100% because 25,000 ordinary shares was invested, and that is exactly what I have on the books of ESCO. So 100%. Now, what is the acquisition date? The acquisition date was 30th June 2017. Okay, now what does that mean? it means that PICO will only have rights to the retained earnings of ESCO starting from that date. Okay? Sorry. Okay. Can't see what I was writing before. Okay. Group structure. Did it erase? Sorry. Okay, I can see it now. So acquisition date is 30th June 2017. And I am consolidating on the same date. Is also what? 30th June 2017. Now, I can go ahead and do my cancellation now. There's nothing else for me to cancel in this instance other than the investment here. I'll say, look at how I'm going to go about it. Purchase consideration. All right. How much? 40,000. Net assets acquired in ESCO. What net asset did you acquire? We acquired ordinary shares. Now, those ordinary shares are worth how much? 25,000. Okay. Now, did this question tell me, remember that we only acquired this company on 30th June 2017. Now, let me see if this question will point to me if they had a retained earnings earlier than that date, okay? The question did not mention that, okay? So what I'll do is I'll say this is, oh, sorry, please. Retained earnings we acquired on that same day. If I take out this net asset, I will have 10,000 naira difference. Now, this 10,000 naira difference is what I will call my goodwill. I'm coming, please. I'm having trouble with my laptop. Okay. So this 10,000 naira will be called, it's not just goodwill, it is goodwill on consolidation. Goodwill on consolidation. Now, what have I done here in effect is this. We acquired this equity, Abi? 25,000 plus 5,000. This total equity was acquired on this day. This is what we paid for it. I am going to cancel out this 40,000 against this 30,000. What I have left is what is going to be consolidated. But I would have to, first of all, cancel out this against this. Now, if somebody may ask, what if the purchase consideration was lower? Now, that will hardly ever happen. In fact, what the standard says is that should you have a negative, go back, go and revalue the net asset of the company you acquired. Go and do further, go investigate further, value it over again. Now, if at the end of the day, you still come back to a case whereby your purchase consideration is a lower amount, let's say 25,000, and here we now have minus 5,000. This will be referred to as bargain on purchase or acquisition. But it is hardly ever the case. What you are mostly going to have is goodwill on. Now, what goodwill on consolidation means simply from the perspective of the acquirer or the parent company is that they estimate that the company is worth more than the estimation of the net asset. And that extra amount they are paying represents that goodwill. So goodwill on consolidation will come up in a case where the purchase consideration and NCI, there we don't have an NCI. It's a very simple and straightforward example. The parent company, ordinarily you add your NCI, but there's no NCI. When we look at the total of this value, and then we check it against the net asset acquired. If the net assets we have acquired is a lesser amount than this purchase consideration and NCI, then we are going to have what is called a goodwill on consolidation. Okay, so when you look at the solution here, you will see that you will see two things you are going to see. First of all, there is now a goodwill on consolidation that has been introduced in the solution. And then again, you see, working for. When you come to retained earnings, we have cancelled out these 5,000 naira retained earnings, yeah? This 5,000 has been cancelled out because as at the day, this is what we paid for. This 5,000 naira was what we paid for as at the day of acquisition. Remember, I told you that the retained earnings that the parent company has right to share is the retained earnings from the day of acquisition. Now, this 5,000 naira is a retained earnings that they acquired, meaning that ESCO had already accumulated this profit before the parent company acquired it. So therefore, it is this 5,000 naira is a pre-acquisition retained earnings. This is not the retained earnings that you are going to share between parent and NCI. This is the retained earnings that you are going to cancel out. Now, if in the following year, in the book of ESCO, we now have retained earnings of 8,000 naira. Don't forget, you will cancel out this 5,000 naira that is coming from pre-acquisition. The only retained earnings that you are going to share between parent and NCI will be 3,000. That is 8,000 minus the 5,000 retained earnings that we should cancel out when we were calculating goodwill. Okay, so it's still the same principle of cancellation. Okay, it's still the same principle of cancellation. So when you look at the solution, like I said, you will not see that retained earnings anymore. If there is a post-acquisition retained earnings, then we can now share that, or we can now add it to the retained earnings of the parent. Okay, so I'm sure by the time you even go about look at how they did the workings for goodwill. The consideration that was transferred was 40,000. NCI, like I said, should be added, but didn't have NCI in this instance. So 0, and then ordinary share capital and the pre-acquisition retained earnings. Could there be other things under net assets acquired? Yes. Anything that represents equity at the date of acquisition will be part of the net assets acquired. What do I mean? I mean, we could have an instance where there is what is it called now? Premium, share premium. We could have an instance where there is a reserve. The company may have reserves, revaluation reserves, whatever type of reserve. In that instance, that will be part of the asset. Now, the aim of this class is still introductory. I'm going to go by Olatunde's suggestion. I'm also going to go by Alexa's suggestion. I'll look at what we can do, to make the class more understandable. But to the best of my knowledge, we've come this far, and I think we can round up for today.